Now the next category you may not have heard of too much of, but it's a relatively newer category of loans that has become more prominent in the last, say, 3 to 4 years. And as we're recording this, is the end of 2023. But non-QM is really a subcomponent of the conventional umbrella. What non-QM is, and it stands for non-qualified mortgages. And the way that it works is you have large hedge funds, banks, portfolio lenders who they have their own money, and they're not going to lend the money based on Fannie Mae and Freddie Mac rules. They're going to come up with their own rules, and they're going to lend that money out. So under this category, you have two popular options. One is called a bank statement program, and this is really for folks who are self-employed. So self-employed people, if they have a good CPA at the end of the year, the CPA goes through their income and expenses, and you're able to deduct certain things that W-2 employees are not able to deduct, like depreciation, mileage. So their income can look a lot less on paper than what it really is. So what the bank statement program allows you to do is you can either provide 12 months or 24 months of bank statements. If you provide 24 months, you'll get a better interest rate because you're allowing the bank to take a look at over a longer period of time. But they'll look at your bank statements and they're going to add up all of your deposits from every single month. And they're going to use that as the starting point for your income. So they add up all the deposits, and then they're going to apply an expense factor, because we all know that it costs money to run a business. There's no business out there that costs nothing to run. And if you use the default expense factor, it's 50%. So for example, let's say you add up all the deposits into the bank statements, and it's $200,000 in deposits for the 12-month period. Well, if we cut it in half, 50%, that means they're going to say your income is $100,000. And that's what they're going to use to qualify you on the mortgage. So it allows you to get a better number for income than what's necessarily showing on your tax returns. You can also, if your CPA can vouch that it costs less to run your business, meaning it doesn't cost me half of my revenue to run my business. Maybe it only costs me 40% or 30%, 20%. If you can provide a CPA letter that says that, then the bank will use that as the expense factor. So if you have $100,000 in deposits and the CPA letter says it's only 20% to run the business, then the bank will count your income as $80,000 for the year. Now the next program is called the DSCR, and what that stands for is the Debt Service Coverage Ratio. This is specifically for investment properties. And what's nice about this program is it does not take a look at your personal finances. All it does is it looks at the property and the property's ability to cash flow. So as long as the mortgage payment and the rent income are equal, we call that 1-to-1, they'll give you that loan. If the mortgage payment is less than the rent income, so the rent that's being generated on that property is more, even better. The bank will actually give you a better interest rate when they see that that property is cash flowing. So they don't look at anything to do with your personal finances. They don't look at your tax returns. They don't look at your W-2s, your pay stubs, none of that. It's strictly the property and its ability to cash flow. Now with the non-QM options, with the bank statement program, you're going to need at least 10% down. And with the DSCR program, because you're buying an investment property, you're going to need at least 20% down.